money and jelly. It's a weird combination for growth and income stocks, but that's what our growth and income stock strategist Todd Bunton is going to talk about here with us, at least from the perspective of investment opportunity. The financial company, or the money company, the money management company, actually is BlackRock, right?
Yeah, they're actually the largest investment management company in the world. Assets under management, 3.936 trillion with a
Wow.
T. Yeah,
let me check that out. Yeah, you're right.
Yeah, with a T. They run the gambit on investment management, mutual funds. They own the iShares brand, ETFs, very popular product. You're seeing a lot. They're seeing a lot of inflows into that. Company's delivered 12 consecutive positive earnings surprises. Their most recent coming on April 16th, where they saw earnings per share jump by 16%. They saw revenue up 9%. Now, some of that is from a rising market. Obviously, if you have assets under management, especially in equities, and the stock market rises, you're going to get higher assets under management and more fees. But they also saw over $39 billion into inflows into their funds. So a very solid momentum there as well. So it's not just a rising stock market. They're seeing customers come to them for their products. If you take a look, their earnings momentum is fantastic. Like I said, 12 consecutive positive earnings surprises. You see a steady rise in consensus earnings estimates over the last several months. Estimates have been rising off their last beat on April 16th, like I talked about. Sent it to a ZAX rank of 2, which is a buy rating. So very good earnings momentum here. And if you look at consensus estimates, analysts expect strong growth for this company over the next couple of years. About 16% earnings per share growth this year and 13% growth next year. So good double-digit growth story here. Again, that's kind of predicated on at least, a stable to slightly rising stock market. If the stock market falls, this is kind of a higher beta stock. It'd be one you'd want to avoid, but so far so good. And if you look, you also get some income along with that. They pay a dividend that yields 2.7%. And they've increased that at a 24% compound annual rate going back to 2004. So very shareholder-friendly company, very solid yield, good growth, and you're getting that at a pretty reasonable price. They trade about 16 times forward earnings. Historically, they traded at 20 times. So it is a discount to that. Could be solid total return potential here in 2013. Again, if the stock market doesn't collapse. That's kind of the key here.
Don't even talk like that.
Of course not.
The company that deals with jelly,
Yeah.
as I mentioned, is JM Smuckers.
Yep.
SJM, the ticker symbol, and with a name like Smuckers, it has to be good.
It has to be
right?
good, right? Yeah, and obviously we know them for the Smuckers brand, their fruit spreads, but actually 50% of their business is in coffee. And particularly retail packaged coffee, because they own
Folgers.
Yeah, they own the Folgers brand. They also own Dunkin' Donuts retail packaged coffee. So that's a big part of their business. They also have peanut butter. They own the Jif brand, shortening and oil. They own Crisco. They also own Pillsbury. So they're very diversified along the packaged food spectrum.
Yeah.
But been around since 1897. We all know them for their Smuckers brand, but they're definitely a lot more diversified than that. The company has seen a solid increase in estimates from analysts after they delivered a solid beat back in February, and that was driven in large part by their international segment. So they're growing in the emerging markets as well. They were able to turn a single-digit increase in overall sales into a double-digit increase in earnings per share because of expanding profit margins. Of course, being in the coffee business, they have to watch those commodity costs, and well, food in general. They have to watch those commodity costs, but they've managed to have expanding profit margins over in the last quarter. So that's very good for them. And if you look at consensus estimates, like I said, analysts have been raising them slightly over the last several weeks. Sent it to a ZAX rank of 2. It's a buy rating as well. Based on consensus estimates, analysts expect 10% earnings per share growth this year, 9% growth next year. So decent growth story here. Along with that, you're getting a dividend that yields 2%. And if you take a look, going back to 2001, they've increased their dividend practically every year at a 10% compound annual growth rate. So very good shareholder-friendly company, solid balance sheet, strong free cash flow. So I'd expect that dividend to increase in the future as long as they can grow earnings per share. You're getting all that at a pretty reasonable price. They traded 18 times forward earnings. That's in line with the industry average. So there could be solid total return potential for this name as well. This one will be a lot more stable than BlackRock, even if the stock market fluctuates. This is one that'll be a little steadier because people always need jelly and coffee.
You would think, wouldn't you?
Yep.
Do you own either one of these?
No, I don't.
All right. We have other stock picks and stock picking strategies that we'd like you to know about. You can find them on our website, zax.com. If you're not there already, get on over and check them out. With Todd, I'm Terry Ruffalo.